Hi, my name's Eric. I'll be reading you selections from this week's Barrons Financial Magazine on behalf of the Audible Local Ledger. This reading is expressly for people who are blind or print disabled. The cover story, there's much to learn from NVIDIA's success. How Jensen Huang Built NVIDIA into the King of AI by Tae Kim. NVIDIA's CEO turned a struggling upstart into the world's most valuable company. It took 30 years. When I started working on a book about NVIDIA in early May of 2023, the artificial intelligence boom was still in its infancy. Based on my years covering the chip sector and tech more broadly, I was confident the party was just getting started, with NVIDIA at the center of it all. The company already fetched a market value of $700 billion. The exclusive trillion-dollar club seemed within reach. But even I couldn't imagine what was about to come. A few weeks into my book research, NVIDIA posted what one analyst called the greatest beat of all time. The company went on to report a series of quarterly results with triple-digit growth rates, an unprecedented stretch for a company of its size. Today, all of big tech is clamoring for its products. Access to the company's graphics processing units had become a question of national security for the world's superpowers, and NVIDIA has a market value of $3.6 trillion, making it the most valuable company of all time. I've been fortunate to have a front-row seat to the run, including interviews with key NVIDIA partners and executives and co-founder and CEO Jensen Huang, who essentially willed NVIDIA into existence 3 decades ago. His story has essential lessons for all tech investors and entrepreneurs. In another life, Jensen Huang might have been a teacher. His preferred medium is the whiteboard, and at many of the meetings he attends at NVIDIA, where he has been the CEO since he co-founded the company in 1993, he will leap up, his favorite chisel tip, dry erase marker in hand, and diagram a problem or sketch out an idea, even if someone else is speaking or whiteboarding themselves at the same time. In fact, he alternates between teacher and student, fostering a collaborative ethos among his employees to develop their thinking and solve the issues they face. His sketches are so precise that they could be turned into usable schematics for technical documents. Colleagues call him Professor Jensen for his ability to explain complicated concepts on the whiteboard in a way that just about anyone can understand. At NVIDIA, the whiteboard is more than the primary form of communication. At meetings, it represents both possibility and ephemerality, the belief that a successful idea, no matter how brilliant, must eventually be erased and a new one must take its place. Every conference room in the company's 2 headquarters buildings in Santa Clara, California has a whiteboard, signaling that each day and each meeting is a new opportunity, and that innovation is a necessity, not an option. Whiteboarding also requires active thinking and inevitably reveals how well or not any employee, including an executive, knows the material. Employees must demonstrate their thought process in real time in front of an audience. There's no hiding behind neatly formatted slides or slick marketing videos. The whiteboard is perhaps the ultimate symbol of the unique culture at NVIDIA, the microchip designer that's grown from humble beginnings in the 1990s, when it was one of dozens of computer graphics chip companies and known mainly by hardcore gamers seeking the best performance for the first-person shooter Quake and other games, into the premier supplier of advanced processors for our age of artificial intelligence. The architecture of the company's processors is well suited for AI workloads because of its ability to perform mathematical calculations simultaneously, essential for training and running advanced large language AI models. NVIDIA's early recognition of the significance of AI and its forward-thinking investments over the course of more than a decade, including enhancement of hardware capabilities, development of AI software tools, and optimization of networking performance, make the company's technology platform perfectly positioned to capitalize on and become the primary beneficiary of the current AI wave. AI use cases are now plentiful. Companies are harnessing NVIDIA-powered AI servers to boost programmer productivity by generating lower-level code that developers find tedious to work. automating repetitive customer service tasks, and empowering designers to create and alter images on the basis of text prompts, enabling the faster iteration of ideas. NVIDIA's reinvention has paid off. On June 18th of 2024, the company surpassed Microsoft to become the world's most valuable company at a market capitalization of $3.3 trillion. It reached that milestone on the back of the immense demand for its AI chips. The company's stock price has tripled over the previous 12 months. To call NVIDIA's stock a historically good investment is to understate things. From its IPO in early 1999 to the end of 2023, NVIDIA investors enjoyed a 33% annualized compounded return, the highest growth rate for any U.S. stock with at least a 20-year trading history. If an investor had purchased $10,000 of NVIDIA stock when it came and made its market debut on January 22nd of 1999, that stock would have been worth $13.2 million on December 31st of 2023. NVIDIA's culture starts with Jen-Hsun Huang, who is simply known as Jensen to his friends, employees, suppliers, competitors, investors, and admirers. This is how I refer to him throughout the book. He had already found a modicum of fame before the AI boom, having been named to Time magazine's list of the 100 most influential people in the world in 2021. But as NVIDIA's value reached $1 trillion and then $2 trillion and then $3 trillion, his profile has grown commensurately. It's now common to see his trademark leather jacket and shock of silver hair, always combed into a simple side part, in articles and video clips, many of which describe Jensen as the genius you've never heard of. To those of us who have covered the semiconductor industry, Jensen has been a known quantity for some time. He's run NVIDIA for its entire 3-decade history, the longest tenure of any current technology CEO. He's driven the company not only to survive, but also to surpass all of its competitors in the unforgiving and volatile chip sector, and to surpass just about every other company on Earth as well. I've been following NVIDIA in a professional capacity for much of my career, first as an equity analyst and now as a journalist, and I've seen how Jensen's guidance and strategic vision have shaped the company over the years. Even so, my view has remained that of the outside observer, dependent as much on interpretation as on concrete fact. To learn the secrets of NVIDIA's success, I'd have to talk with many people inside and outside the company. I would also have to speak with Jensen himself, to become his student, much like his employees do. I got my chance just 4 days before NVIDIA became the most valuable company in the world. NVIDIA knew I was writing a book, and in early June of 2024, a representative offered to arrange a meeting with Jensen to occur immediately after his commencement address to the California Institute of Technology, Caltech's graduating class of 2024. I agreed, and a few minutes before 10 a.m. on Friday, June 14th, I found myself in front of a stage waiting for Jensen to appear. It was a perfect California day, clear blue sky and warm sunshine. The students and their families took their seats under a large white tent. David Thompson, the chair of Caltech's Board of Trustees, introduced Jensen and joked that the NVIDIA CEO had drawn so much attention earlier in the day as the two made their way around campus that it felt like he had been walking alongside Elvis. During his speech, Jensen suggested to the students that their graduation from Caltech would mark one of the peaks of their lives. He mentioned that he knew something about peaks too. We're both at the peaks of our career, he said. For all of you who've been paying attention to NVIDIA and myself, you know what I mean. It's just that in your case, you'll have many, many more peaks to go. I just hope that today's not my peak, not the peak. He vowed to work as hard as ever to ensure that there would be even more peaks ahead for NVIDIA, implying that the new graduates should follow his example. After Jensen concluded, I was whisked over to the Keck Center for Space Studies and led into a wood-paneled conference room with black and white photos of pilots, astronauts, and presidents on the walls, where he was waiting for me. We chatted a bit before I got to my prepared questions. I explained that I was a PC gaming nerd who had been building my own computer since the 1990s. I first encountered NVIDIA while researching graphics cards and invariably chose its products. And I mentioned that earlier in my career at a Wall Street fund, an investment in NVIDIA became my first big winner. Good for you, Jensen deadpanned. NVIDIA is my first big winner, too. We launched into a wide-ranging discussion of the company's history. Jensen knows that many of his former employees look back on NVIDIA's beginnings with nostalgia, but he resists overly positive accounts of NVIDIA's startup period and his own missteps. When we were younger, Tay, we sucked at a lot of things. NVIDIA wasn't a great company on day one. We made it great over 31 years. It didn't come out great. He said, you didn't build NV1 because you were great. He said, NVIDIA didn't build NV2 because you were great, he said, referring to the company's first two chip designs, both of which were flops that nearly killed NVIDIA. We survived ourselves. We were our own worst enemy. There were several more near-death experiences, but each time, amid the stress and the pressure, the company learned from its mistakes. It retained a core of die-hard employees, many of whom remain in the fold to this day. Of course, there were also people who didn't stay, requiring the company to integrate new hires. Every single time somebody left, and every single time we picked ourselves up, we healed the company into existence. He slipped into the third person. If Jensen wasn't even involved in the first 15 years of our company, I would really like that, he laughed, meaning he wasn't proud of how the company was managed then, or of his own naivete and lack of strategic thinking. I was put in the unusual position of defending NVIDIA's past to its founder. I pointed out that the early decisions, about which I had learned a great deal by this point in my research process, weren't all bad ones. While mistakes were made, some of the misfires were tied to factors that were unpredictable or out of his or the company's control. With hindsight, many of them appeared to have been unavoidable. Yeah, that's fine, said Jensen. I don't love talking about our past. I found this to be a pervasive attitude within NVIDIA, that the culture of the place discourages looking backwards, whether at errors or successes, in favor of focusing on the future, the blank whiteboard of opportunity. But you cannot understand what NVIDIA is today without understanding how it got to this point. During the course of my reporting, I began to understand what makes NVIDIA special. Its defining characteristic is not its technological prowess, which is more a consequence than a root cause. It's not the financial resources and the new opportunities that come from a high market valuation. It's not a mystical ability to see the future. It's not luck. Rather, it's a unique organizational design and work culture that I've come to call the NVIDIA way. This culture combines unusual independence for each employee with the highest possible standards. It encourages maximum speed while demanding maximum quality. It allows Jensen to act as strategist and enforcer with a direct line of sight to everyone and everything at the company. Above all, it demands an almost superhuman level of effort and mental resilience from everyone. It's not just that working at NVIDIA is intense, though it certainly is. It's that Jensen's management style is unlike anything else found in American corporations. Jensen runs the company in the way he does because he believes that NVIDIA's worst enemy is not the competition, but itself. More specifically, the complacency that grips any successful company, particularly one with a long and impressive track record such as NVIDIA. In my work as a journalist, I've seen that companies tend to become dysfunctional as they succeed and grow, largely because of internal politics, with employees focused not on driving innovation or serving customers, but on advancing their bosses' careers. This jockeying distracts them from doing their best, and it leaves them constantly looking over their shoulder for the threat from the next office over. It's something that Jensen has structured NVIDIA to eliminate. Over the years, I realized what was happening, how people protect their turf and they protect their ideas. I created a much flatter organization, Jensen said. His antidote to the backstabbing, the gaming of metrics, and the political infighting is public accountability, and if needed, public embarrassment. If we have leaders who aren't fighting for other people to be successful and depriving opportunities to others, I'll just say it out loud, he said. I got no trouble calling people out. You do that once or twice, nobody's going to go near that again. NVIDIA's unique culture might sound strange or unusually grueling even for the tech industry, but among all of the former NVIDIA employees I talked to, it was hard to find a dissenter. They all reported that the company was largely free from the interwork politics and indecisiveness typical in large organizations. They mentioned how difficult it was to adjust to working at other companies where direct, blunt communication is rare, and there's far less urgency to get things done. And they described how NVIDIA not only empowered them, but also required them to fulfill their professional calling as a necessary condition of employment. In a sense, that is the NVIDIA way in its purest form. It's the unwavering belief that there's tremendous reward in doing your job the best you can. It's the drive to persevere amid adversity, or as Jensen put it when looking directly into my eyes, the secret to his company's success is nothing more than sheer will. More precisely, it is Jensen's personal will that has shaped NVIDIA. He's made the most consequential decisions in its history. His ability to place the right major bets on emerging technologies stems from his deep technical knowledge, a founder with an engineering background. I've tried in this book to distill the NVIDIA way down to a set of principles that anyone can learn from, if not use. But behind them all lurks a question. Can you really separate NVIDIA from its CEO? As of this writing, Jensen is 61 years old. He's run the company for 31 years, more than half of his life. NVIDIA is bigger, more profitable, and more crucial to the global economy than ever before. Yet, it still relies on Jensen as a business leader and a tone setter. Apple survived the ouster of Steve Jobs in 1985 and his death in 2011. Amazon.com, Microsoft, and Alphabet all did well after Jeff Bezos, Bill Gates, and Larry Page and Sergey Brin wanted to move on. Someday, NVIDIA will have to face a similar transition. It's not quite clear what the company might look like post-Jensen, whether its culture will survive, whether it will maintain its momentum. After all, a whiteboard's only as useful as the person who holds the marker. It can reflect genius, but it cannot create it. This was excerpted from The NVIDIA Way, Jensen Huang and the Making of a Tech Giant by Tae Kim. It'll be published on December 10th, and it was used with permission of the publisher W.W. Norton & Company. The next headline in Barron's weekly financial magazine, Trump's Trade War Will Upend Economies by Reshma Kapadia. The battle lines will be different this time, how China will respond, and what it means for U.S. markets by Reshma Kapadia. The tariffs are coming. The scope, targets, and even the ultimate objective remain unclear, but President-elect Donald Trump is widely expected to unleash a new front on the trade battle that he started in his first administration. Trump, who's described tariffs as the most beautiful word in the dictionary, has consistently viewed duties as a valuable weapon, a reason that investors are taking seriously the risk of 60% tariffs on goods from China and 10 to 20% universal tariffs on all other imports. They serve another purpose. Revenue paid by U.S. companies importing goods could be used to offset the tax bill Trump has promised. Scenario planning has started in earnest among investors, trading partners, and companies such as cosmetics maker LF Beauty and toolmaker Stanley Black & Decker, which have already warned investors about the prospects of higher prices and curtailed growth in the event of more tariffs. The International Monetary Fund, the IMF, has warned that a tariff battle, one that doesn't escalate into a full-on trade war, could shave 0.5% off global economic output in 2026. Investors who remember the trade battle that Trump waged in 2018 and the volatility from the tit-for-tat between U.S. and China as their relationship fractured are reviving their old playbooks. one nugget of optimism, markets were calmed once Trump struck a so-called Phase 1 trade deal that rolled back some of the tariffs in return for China vowing to make some reforms, as well as committing to buy aircraft engines, soybeans, and services. China didn't keep the promise. This time around, investors are grappling with a changed backdrop that could make a trade battle that ignites inflation and dents global growth more complicated. Inflation is much higher, Europe's growth is anemic, and China's economy is sputtering. Trade patterns have also been reshuffled so that beneficiaries the last time around, such as Mexico, could now be in the Trump administration's crosshairs as countries, including China, reroute trade to circumvent duties. China has revved up its export machine, sending its excess supply of electric vehicles, steel, and chemicals abroad, pushing countries to impose their own tariffs to protect their domestic manufacturers. The world is entering an era of protectionism, warns Eswar Prasad, Cornell University professor and former head of the China division at the IMF. The U.S. turning aggressively to tariffs, and the second largest economy in the world desperate to expand its exports, creates the perfect storm. How nasty the storm gets depends on a complicated exercise with a host of characters abroad and at home. Part of it depends on who holds sway in the new administration. It's expected to include China hawks like Robert Lighthizer, a protectionist who's pushed for less reliance on China and who crafted trade policy in the first Trump administration, as well as an array of advisors like Tesla's Elon Musk and Blackstone's Steven Schwarzman, who have strong business ties to China. That variability, with the most extreme scenarios creating the most precarious tariff backdrop since the 1930s, is keeping many strategists cautious about big bets abroad and tilting toward U.S. stocks as they game out potential scenarios. Trump's long-term focus on trade imbalances puts China in the spotlight. Its trade surplus is approaching $1 trillion as the country leans on exports to help its ailing economy. But while the surplus has grown, China is increasingly selling more to other parts of the world than the U.S. Its goods deficit with the U.S. fell to $279 billion last year from $343 billion in 2019. Still, China is widely expected to be the first target, offering the cleanest route to imposing tariffs amid bipartisan support for a tougher stance against the People's Republic. Analysts expect the new administration as early as the first day to label China in violation of the Phase 1 trade deal, setting in motion an enforcement mechanism that could impose tariffs on China within months. Roughly half of Chinese imports are already subject to tariffs, averaging about 10%, according to the Peterson Institute for International Economics. An escalation would target the remaining half, which includes consumer electronics and staples that are found at dollar stores, as well as chemicals and other inputs for industry in industrial companies. It would cause inflationary pressure on those who can't handle it, says Vita Partners' Henrietta Trays, noting the likely hit on middle-class households. Oxford Economics estimates that raising tariffs on Chinese goods to 60% could boost the U.S. Consumer Price Index by at most 0.7%, while a blanket 10% tariff could add another 0.3%. A phased approach? Tariff increases could come in phases. Mary Lovely, senior fellow at the Peterson Institute, expects the new administration to issue pre-exemptions that shield some companies or subsectors, possibly within consumer goods. That could mitigate some of the inflationary pressures. Most analysts expect the trade battle to unfold in segments, since placing tariffs on China, as well as universal tariffs of as much as 20% on the EU, United Kingdom, and others, would increase the risk of an inflationary spike, and it would rattle markets, as companies wouldn't be able to find a safe alternative place to source goods. Tariffs would be everywhere. The most optimistic scenario calls for an initial salvo of tariffs on China, followed by an attempt at deal-making. The strength of the U.S. economy, concerns about China as a strategic rival with its own economic challenges, could give Trump a strong hand. we see a lot of governments trying to think about how they'll appease him. The U.S. economy will continue to grow, and it's an important market for everyone, Lovely says. Chinese officials have been visiting Washington, D.C. for months to gauge what type of deal could be appealing, says Derek Scissors, a fellow at the American Enterprise Institute who recently served as a commissioner on the U.S.-China Economic and Security Commission, which advises Congress on China-related issues. The Trump administration's lesson from the first deal, where China didn't honor its commitments to buy an additional $200 billion in exports, probably means that the administration first places tariffs, probably 50%, before entertaining any deals. China's economic troubles could coax its officials to come to the table sooner, possibly with bigger commitments to buy U.S. agricultural products and energy, as well as possible investment in production in the U.S. that could create jobs. While more hawkish prospective members of the administration have advocated curtailing Chinese investment in the U.S., Scissors thinks that there would be some sectors that aren't off limits where Trump would welcome investment. Critical to any sort of deal is assessing what the new administration's objective is and what the Chinese think it is, says Logan Wright, who leads Rhodium Group's China Markets research. If the Chinese view the tariffs as a stick to get them to invest more in the U.S., Wright expects a more modest tariff increase, and possibly only a temporary one. But if China sees the battle as a way to punish its economy or accelerate decoupling, a deal is less likely, and retaliation could be sharper, possibly with measures to disrupt the revival of U.S. manufacturing through critical mineral restrictions or their own tariffs on inputs to intermediate goods that raise prices. Even in a more benign scenario, China is likely to retaliate to a tariff increase, albeit in ways that may not hurt as much at first. U.S. agricultural products are a likely target. Economists expect a trade battle to potentially shave 2 percentage points off Chinese economic growth, far from ideal for a country already trying to stabilize its growth. To cope, China will probably redouble efforts to reduce reliance on the West, and it will probably step up fiscal stimulus, possibly with subsidies for exporters hit by tariffs to ensure the pain doesn't lead to job cuts. Beijing could also devalue the renminbi to offset some of the hit, but this comes with some dangers. While China could handle a 3 to 5% depreciation, a 10 to 15% weakening could trigger a wave of devaluations among emerging markets looking to maintain their competitive position. And that could risk capital outflows and financial instability, Prasad says. If no deal looks likely within a month or two of the U.S. imposing tariffs, markets will get jittery as the risk of escalation by the U.S. increases. Beyond raising tariffs even further, Scissors says the U.S. could look to levy duties on Chinese companies operating elsewhere, like in Mexico, to circumvent tariffs, or find ways to restrict U.S. companies' investments in China. Other market spoilers persist too. Congress has introduced a bill to revoke China's permanent normal trade relations status, which was granted in 2000, a move Lighthizer has advocated for years, and if passed, it would ratchet tariffs higher and bring tensions to a new high by putting China in the same camp as North Korea and Russia. This is a far-reaching, potentially permanent, and quite dramatic change to the U.S. trade landscape, says Trays, who sees 40% odds of such a bill passing. That would rattle markets, with the Peterson Institute estimating the move and resulting retaliation could increase the U.S. Consumer Price Index, the CPI, by 0.6% and lower U.S. gross domestic product by almost $160 billion between 2025 to 2028. The other channel for a trade battle is blanket tariffs up to 20% on goods from the rest of the world. If the administration imposes these tariffs at the same time it goes after China, strategists expect a much bigger sell-off in markets and a larger inflation hit. For now, many expect Trump to tap the International Emergency Economic Powers Act to start with a 10% duty later in the year. The U.S. doesn't export that much to Europe, limiting the potential retaliation to a handful of goods like Harley-Davidson motorcycles or whiskey. In this scenario, the economic hit to the region could be limited. Andrew Kenningham, chief Europe economist at Capital Economics, estimates a 0.2% hit to the region's GDP if Trump levies a blanket 10% tariff. Germany's auto sector could face a harder time. Trump has complained about Germany's large trade surplus, and specifically its auto sector, which tends to design and make cars at home, but sends them to the U.S. for final assembly. Though the sector could ride out a 10% tariff, Kenningham says German automakers would have a harder time absorbing a 20% tariff. They would probably have to raise car prices, which could dent their sales in the U.S. by 50%, resulting in an additional 0.2% hit to Germany's GDP. Hitting Europe with tariffs would probably rattle markets, Trey's says. For now, Pantheon macroeconomics economist Klaus Vistesen expects the European Central Bank to cut interest rates less than expected as it waits to see the scope of Trump's tariff battle. The situation with Mexico is even trickier. While Trump has proposed 200% tariffs on cars made in Mexico, analysts say placing tariffs on Mexico would put the U.S. in violation of the U.S.-Mexico-Canada trade agreement. That was one of the hallmarks of the first Trump term. Also problematic, U.S. companies have invested aggressively in Mexico to diversify production. That could create a loud lobbying pushback against the tariffs. Analysts expect the administration to use saber-rattling about a tariff to push President Claudia Sheinbaum to impose new immigration rules at the border, helping Trump make progress on another priority, Trey says. Mexico's economy could be in for a tough period, with potential deportations driving up unemployment and the Chinese investment powering Mexico's growth potentially coming under increased scrutiny. The iShares MSCI Mexico Exchange-Traded Fund is down 25% this year. Nuveen Chief Investment Officer Saira Malik favors U.S. stocks, especially more domestically focused companies that are better insulated from tariffs, and is wary of making any foreign bets. Others are also cautious. Sometimes you just have to wait, said Ian Shepherdson, chief economist at Pantheon Macro, in a briefing. The potential policy changes are quite gigantic, or it could be all a huge bluff. We'll move to the review and preview section of Barrons for the issue date of November 18th, a Monday. Techs tank S&P payouts. Yield is rapidly disappearing from the S&P 500 index as tech stocks whose payouts are tiny relative to their prices make up a record share of the index. At Friday's close, the dividend yield on the S&P 500 stood at 1.27%, based on payments made over the past 12 months. Early in the week, the index topped 6,000 for the first time, a record. That's the lowest dividend yield since it hit 1.17% on February 12th of 2001. Tech stocks then also accounted for a big chunk of the index. The highest yield for the index since 2001 was 4.1% in March of 2009, as stocks sank to their low point during the 2008-09 financial crisis. Tech stocks led by Nvidia, Apple, and Microsoft made up 32% of the S&P 500 on Monday, more than twice the share of financials, the second largest group at 14%. 3 tech stocks that account for 20% of the index pay tiny dividends. Nvidia yields 0.03%, Apple 0.5%, and Microsoft 0.8%. Other tech-oriented giants such as Amazon, Alphabet, and Meta Platforms also have little to no yields. Amazon has no dividend, nor do 2 other top 10 S&P 500 stocks, Tesla and Berkshire Hathaway. The upshot is that in the S&P 500 at least, there's no meaningful yield for investors to reinvest, which would provide so-called dividend support for the index. The situation isn't any better with mid-cap stocks, with the S&P Mid-Cap 400 yielding only 1%. That's reported by Andrew Barry. Last week, markets. The week began with Bitcoin prices busting through $80,000 towards $90,000. The climate summit reached a deal to launch a global carbon market. October inflation edged up to 2.6% annually, and Fed Reserve Chair Powell cautioned on rate cuts, sending the dollar and Treasury yields up and stocks down. On the week, the Dow Industrial sank 1.2%, S&P 500 2.1%, and the Nasdaq Composite 3.2%. Post-election honeymoon is over. In companies, the FTX bankruptcy estate sued Binance and its former CEO for $1.8 billion, claiming a fraudulent share deal. Alibaba Group said it was seeing a record number of shoppers as China began Singles' Day sales. AbbVie's schizophrenia drug flopped in tests. Volkswagen boosted its support of a joint venture with Rivian Automotive to $5.8 billion. Trump named Elon Musk and Vivek Ramaswamy to run a Department of Government Efficiency, or DOGE, D-O-G-E, and nominated Robert Kennedy Jr. to Health and Human Services. Palantir Technologies left the New York Stock Exchange for the Nasdaq. In deals, Elliott Management urged Honeywell International to break up. Cigna said it wouldn't acquire Humana. Seven & I Holdings began talks with Alimentation Couche-Tard, but said a $58 billion bid had emerged from the chain's founding family. European food delivery company Just Eat, Takeaway.com, agreed to sell Grubhub for $650 million, including debt, to former Walmart exec Mark Lohr's Wonder. Just Eat bought Grubhub in 2021 for $7 billion. This week, for the preview, Monday, November 18th, several economic releases give us an update on the state of the housing market. On Monday, the National Association of Home Builders releases its housing market index for November. And on Tuesday, the Census Bureau reports new residential construction data for October. Economists forecast a seasonally adjusted annual rate of 1.34 million housing starts, about even with September. On Thursday, the National Association of Realtors reports existing home sales for October. Consensus estimate is for a seasonally adjusted annual rate of 3.93 million homes sold, slightly more than in September. On Tuesday, November 19th, third quarter earnings season winds down, with more than 85% of S&P 500 companies having already reported results. The week's highlight is NVIDIA's earnings, which will be released after the market close on Wednesday. Retailers Lowe's and Walmart announce results on Tuesday. Then Palo Alto Networks, Target, and TJX companies on Wednesday. Deere and Intuit hold conference calls to discuss quarterly results on Thursday. Friday, November 22nd, S&P Global releases its Manufacturing Purchasing Managers Index for November. Expectations are for a 48 reading, which is half a point less than in October. The numbers: 4.5%. That's the growth in global coal consumption in 2023 from some 6,500 coal power plants to its highest level ever. $2.4 trillion. That's global military spending in 2023, up 6.8% year over year. The U.S. was number one at over $900 billion. 35%. How much bond trader bonuses could rise in 2024 in a forecast by pay consultant Johnson Associates. And 6.78%, the average rate of a 30-year mortgage this past week. That's down a basis point despite Fed interest rate cuts. From the Streetwise section of Barrons for November 18th, The Little-Known Company Suddenly Worth $100 Billion by Jack Huff. We're cautious on near-term business fundamentals and long-term competitive positioning, one Wall Street analyst wrote near the beginning of last year when AppLovin's shares were $11. He initiated coverage at sell and predicted a fall to $7. Oopsie! Now they're $280. Anyone can get a stock call wrong. I mentioned the analyst, still the only bear on AppLovin, according to FactSet, partly to distract readers from asking why I'm writing about the stock so late. The answer, and I'm outraged about it, is that I can't actually tell ahead of time which stocks are going to rocket higher. It's a real career hindrance. Also, things in this case have happened quickly. More than $100 of the stock's climb has come this month. Let's quickly try to answer a few questions. What's an AppLovin, and why is it suddenly worth $100 billion? And that is spelled capital APP, capital LOVIN. Is there any way that investors could have seen this coming? And how does the stock stack up now? AppLovin dates back only to 2012, making it younger than, say, Siri on the iPhone. There's a 2007 movie called Superbad, wherein a high schooler seeking to buy alcohol secures a fake Hawaii driver's license with his photo and the name McLovin. This was not the inspiration for the name unless it was subconscious, said co-founder and CEO Adam Ferruhi. AppLovin was just a quick, playful idea that happened to be available as an $8 domain name. The company has a software platform that helps app developers, mostly game makers, reach new users who'll download the apps and become paying customers. At the heart of it is a recommendation engine powered by artificial intelligence called Axon. The company can also help app owners grow in-game advertising revenue, and it has a couple of hundred of its own casual games which make money and generate valuable user data. AppLovin's AI is getting smarter, which is driving better results for customers and rapid growth for itself. Third quarter results reported on November 6th showed revenue rising 39% to $1.2 billion and adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA, jumping 72% to $722 million. Free cash flow was $545 million. That's up 182%. As Ferruhi explained days before in a fireside chat with investors, he had difficulty early on selling his idea to venture capitalists, so he's run AppLovin from the start to maximize free cash flow, not revenue growth. The stock debuted in April of 2021. It closed down 18% on its first day at $65 and change. There was a pandemic glut of game makers going public. Plus, app gatekeepers like Apple were rolling out new rules on user privacy, which were seen as a threat to the data tracking that online advertising relies upon. In 2022, AppLovin paid about $1 billion for a marketing unit of Twitter, just before post-pandemic ad spending by game makers slumped. Shares fell below $10 near the end of the year. Early in 2023, AppLovin launched Axon 2.0, and although the engineering improvements were a black box, performance improvements since then have been clear, and shares have been climbing. What has investors particularly upbeat now is the company dipping a toe outside of games into e-commerce. It's the best product I've ever seen released by us. Fastest growing, said Ferruhi on the latest earnings call. Financial results there, he said, are likely to make an impact next year and beyond. That has some investors comparing AppLovin to digital advertising specialist Trade Desk, although AppLovin is already larger by stock market value. How could investors have spotted AppLovin stock sooner? I suppose that regular screens for price momentum would have helped. The action picked up starting around September. Screens for earnings day outperformers might have been useful too. AppLovin beat earnings estimates by double-digit percentages in its past 6 quarterly reports, and shares responded with double-digit gains after 5 of them. The aforementioned lone bear on Wall Street has brought his price target up to $66. Cracking e-commerce will be challenging, he wrote back in August, especially because AppLovin lacks the first-party data that it gets in gaming from owning its own titles. Also, he wrote, look for Apple to tighten privacy rules further and make a bigger move itself into advertising technology. That's a key risk, although AppLovin has so far navigated tracking changes nimbly. And Apple must be careful about being seen as using its vast market share to stifle competition. UBS's analyst made a prescient AppLovin upgrade to buy from neutral at about $116 in September. He's still bullish. One thing that isn't yet baked into expectations, he wrote this month, is a potential launch in the future of a self-service platform for advertisers. Alger portfolio manager Amy Jean calls AppLovin one of her favorite stocks. Since incremental costs are modest, she says, much of the revenue growth turns into free cash. The latest Wall Street consensus has AppLovin generating free cash flow of $2.4 billion next year, which puts its recent $100 billion stock market value at a lofty 41 times that figure. Too much? Zhang has a cheaper idea, but not by much. She also likes a company half the size that does power and cooling for AI data centers called Vertiv Holdings. That one goes for about 35 times next year's projected free cash flow. Don't worry, it's not up 2,600% since the beginning of last year, like AppLovin, only 800%. By the way, hitting a $100 billion market value used to be a big deal. General Electric was America's first in 1995. Now a fifth of S&P 500 companies are that large. A rising number over time is to be expected, but the median company in the 12-digit club now goes for 25 times this year's projected earnings. Maybe AI is about to unlock untold new riches for most of them. Or maybe prices are just stretched. Up and Down Wall Street section from Barrons of November 18th has a headline that reads, Inflation and DC uncertainties bring stocks back to earth. This is by Randall Forsyth. The Trump rally in the stock market stumbled this past week, in no small part owing to the president-elect's controversial appointments to the incoming administration. After hitting a record just over 6,000 on Monday, the S&P 500 index shed a little more than 2% this past week, with a 1.3% drop in Friday's session. The tech-dominated NASDAQ composite fell even more sharply, losing over 3%, while the Dow Jones Industrials managed to lose only 1.2%. As my ever-perceptive colleague Andrew Barry pointed out, the market stumbled after the announcement of President-elect Donald Trump's controversial nominations of Florida Representative Matt Gaetz for Attorney General, former Hawaii Representative Tulsi Gabbard to head Intelligence Services, and Robert F. Kennedy Jr. to run Health and Human Services. From the pure dollars and cents calculus of the financial markets, the all but certain fights over these names threatened to scuttle or at least slow the pro-growth initiatives that were behind the Trump rally. The markets like predictability and stability, and Trump has delivered neither in the past 24 hours, wrote Greg Valeri, a veteran Washington watcher and chief U.S. policy strategist at AGF Investments, in an email on Thursday. Is he looking for the best possible people, or does he want to send a message to his rivals? If it's the latter, we're in for a long 4 years. No need to waste space detailing accusations against Gaetz. Other than that, the chances of his confirmation are already dimming. Odds of the Senate approving his nomination were only 29% on Polymarket. That's the betting site that was far more prescient than pollsters in predicting the presidential vote. The most important takeaway from these DC doings, at least from the market's unemotional perspective, is that they threaten the new administration's ability to pass tax legislation in the first half of next year, according to a research report from Strategis's ACE Washington Policy and Analysis team led by Daniel Clifton. The loss of 3 members of the House of Representatives, Gaetz, Mike Waltz, also from Florida, tapped as National Security Advisor, and Elise Stefanik from New York for United Nations Ambassador, could eliminate the 2 or 3 seat GOP majority in the House temporarily, they wrote. The Strategis team didn't expect Florida to hold special elections to replace Gaetz and Waltz until May, while in New York the governor has up to 90 days to set an election. The net effect is that the Republicans might be delayed in moving forward on tax legislation unless every member agrees with every provision of a $4 trillion package, says the Strategas team, referring to the renewal of the Tax Cuts and Jobs Act, which expires or sunsets at the end of 2025. The GOP would probably want to pass an extension of the TCJA in the first half of 2025 before an increase of the debt ceiling, the suspension of which ends on January 1st, to maintain certainty for consumers and businesses. The more mundane matter of raising and rising bond yields also weighed on stocks. The 10-year Treasury note hit the 4.5% mark on Friday, which proved nettlesome to equities in the past. That was up 88 basis points, hundredths of a percentage point, from its recent low in mid-September. There have been two big changes in the bond market's perspective: the increased recognition of the impact of the budget deficit, and while the economy is perking along nicely, inflation isn't receding further. The Federal Reserve Bank of Atlanta's GDP Now shows inflation-adjusted annual growth estimated at 2.5% annual rate in the current quarter. That's roughly in line with the third quarter's preliminary estimate of 2.8%. Meanwhile, progress in reducing inflation has stalled. John Riding and Conrad de Quadros, economic advisors to Breen Capital, note that core consumer prices, excluding volatile food and energy, rose by 0.3% for the third straight month in October. That brought the 12-month rate to 3.3%, the same as in June, and significantly above the Fed's 2% inflation target. Adding to the upward pressure on bond yields was Fed Chair Jerome Powell's comment on Thursday that monetary authorities don't need to be in a hurry to lower their short-term interest target. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully, he said at a Dallas Fed symposium. That contrasts with a double-quick 50 basis point cut in September, when the Fed initiated its rate reductions, followed by a more typical 25 basis point reduction the week before last. But the probability of a similar trim in December has slipped substantially to 58.4% on Friday from 64.6% a week ago and 85.5% a month earlier, according to the CME FedWatch site. This Fed easing looks premature and recalls a similar episode in 1966 over 67, according to a research note from Macro Intelligence 2 partners. Then, the Fed reversed its previous aggressive tightening following turbulence in the banking sector and a tumble in stocks. The easing, combined with the fiscal stimulus of the guns and butter policies of the Johnson administration, set off waves of inflation that surged through the 1970s. Rising stock prices and bond yields means the equity risk premium has dwindled to almost nil, according to a Rosenberg research report. That leaves no margin of safety for investors as they confront a less certain political future than they anticipated after the GOP sweep just a few weeks ago. Is there anything Elon Musk can't do? After defying skeptics who said he couldn't sell 2 million Teslas or launch and retrieve rockets from space, slashing $2 trillion a year from the federal budget should be easy peasy, according to his legions of fans. Musk and Vivek Ramaswamy, who have been tasked with heading the newly established Department of Government Efficiency, or DOGE, are aiming to eliminate a cool $2 trillion in federal spending. Trouble is, of the $6.1 trillion in annual federal outlays, only $1.7 trillion of it is discretionary. And the bigger problem is that non-discretionary spending, especially interest on the debt, is soaring, and there's nothing this dynamic duo can do about that. The reality is that the cuts they can make will be far less substantial than those required to make any meaningful dent in our runaway finances, writes Stephanie Pomboy, founder of Macro Mavens. As for Elon's hatchet to bureaucracy, total government wages and salaries are a little over $800 billion annually. That isn't enough to matter, at least to the bond market, as has been highlighted ad nauseum in this space for the past year and a half. All of those notes and bonds issued at never-before-seen and never-to-be-repeated interest coupons of 1% and less that are coming due will be replaced by debt with more normal yields in the 4% range. And so Uncle Sam's interest tab has climbed from $628 billion in 2023 to just under $900 billion in 2024. And currently it's running at $1.2 trillion annually, Pomboy says. Barring cuts to entitlements, which no one is talking about, rates are going to be higher for longer despite the efforts of Elon and Federal Reserve Chair Jay Powell, she concludes. Far from the $2 trillion expense cut fantasy, the incoming Trump administration's top economic priority is to extend the Tax Cut and Jobs Act, the signature measure of his first term, which expires at the end of 2025. That'll cost $4 trillion over the next decade, 2.5 times as much as the original $1.6 trillion, according to the Peter G. Peterson Foundation. That doesn't mean there are no cuts to be made. The Committee for a Responsible Federal Budget listed this past week $700 billion of easy deficit reduction for the next decade. Among the savings, some $50 billion would come from closing the electric vehicle credit leasing loophole, which gets around restrictions on the $7,500 federal tax credit for EV purchases, depending on their origin and the buyer's income. That isn't likely to be high on the Tesla chief's list of cuts. More to Musk's liking might be to use artificial intelligence to boost efficiency. Macquarie strategists Terry Wiseman and Gareth Berry cite one estimate that automating routine administrative tasks could boost U.S. government productivity by $519 billion annually, for $5.2 trillion in savings over 10 years. AI also could reduce the deficit by detecting tax evasion and improving the selection of tax returns for audit, they add. Improved compliance could boost revenue by $4.8 trillion over 10 years without boosting tax rates, they note. Wiseman and Berry further point to static analysis, estimating that tariffs favored by President-elect Donald Trump of 10 to 20% could bring in $2 to $3.3 trillion over 10 years. But tariffs are a risky way to raise government revenue, they add, given the possibility of retaliation by trade partners. They note a tax foundation analysis that negative economic impacts could actually result in lower overall fiscal revenue. None of these measures comes close to the $2 trillion annual savings that Musk and Ramaswamy seek. Meanwhile, if Trump's promise to extend the TCJA plus enact campaign pledges to exempt Social Security and tips from taxes, boost the cap on state and local tax deductions, and reduce the corporate tax rate to 15% from 21% for manufacturing firms all come to pass, the already huge federal deficit of 6.5% of all gross domestic product would widen further, writes Olivier Blanchard, former chief economist at the International Monetary Fund for the Peterson Institute for International Economics. If Trump enacted all the measures he has suggested, a question would be how many years it will take for investors to question the risk-free status of U.S. Treasuries, he writes. Leaving aside this risk issue, what is likely, however, is that a further fiscal expansion starting from an economy close to full employment will lead to inflation, and by implication, higher Fed policy rates and a strong dollar. Once again, this scenario will trigger a potential conflict with the Fed. If the Fed sticks to its mandate, Blanchard says, it will stand in the way of some of Trump's policy goals and have to increase rates to limit economic overheating, leading to dollar appreciation. As I wrote a week ago, the risk is that the U.S. Central Bank instead underwrites higher inflation, so the economy expands briskly enough to keep pace with the debt. That's what the recent rise in bond yields suggests. And with that article, which was written by Randall Forsyth, we have come to the end of our reading of Barrons Financial Magazine for November 18th of 2024. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.